we are starting Rich Dad's Advisor Tax-Free Wealth Second Edition, and our fearless leader is Natalie. We will be discussing, I don't know if you're going to talk about the intro all the way through chapter 6, but I know that we were supposed to read through chapter 6. I read through chapter 5. I failed miserably because I listened to the whole intro, so I ran out of time for the last chapter.
With that extra week.
There you go, there you go, there you go. But that is what we are discussing today. So Natalie, take it away. The floor is yours.
Awesome. Well, welcome, guys. I got the hard books. That way I bought the Audible, I bought the hard book. So if there's anything that you guys think that there's a picture of, I'll share it with you guys, because there's a few themes that they have in here that I think might add some value to as you read through it. But I thought this was an interesting book, especially after the last one that we just finished up. And it's kind of ironic that we chose this book because we didn't realize it was actually a part of the Rich Dad series until after we picked it. So it was a good transition, easy transition, because I think we have already a base knowledge of that topic. So jumping into this book, I felt, personally, I don't enjoy paying taxes. I've always felt it was something you just had to do, and love to see that number drastically reduce. And so it was exciting to even just read these first 6 chapters and see that the possibilities there. And not only does the government want you not to pay taxes, but they're there to help you not pay taxes. So just jumping into, I kind of skipped through the introduction, although I thought it was really interesting, especially the forward where the rich dad of, the rich dad of the Rich Dad book series shared his input too. I thought that part was interesting. Did you guys have any comments on that part before chapter 1?
You talks through his his experience, like his own experience and his own education and his own background, essentially.
Yeah. Yep.
Yeah, it was actually really interesting because it almost kind of so clearly he understands text way more than I do. Just from the way that he explains it, you can tell he really truly gets it. But understanding the topic, it's really kind of good to know like how he got into the topic, and because it almost gives you an inkling of, this is how he understands it and like why he understands it, and he's going to teach it from this standpoint. But that's kind of how I felt about that chapter. It was really cool. I was glad I read it. I think it was before the chapters.
Yeah, no, that makes me feel a lot better, David, because I feel like this is a little bit higher level, not too into the details. So hearing even from your perspective in your employment history of working in accounting and CPA, and that I felt like a little bit's over my head of what he's done and what we should be doing. So thank you for that, your input. Okay, well, the first chapter was taxes are stealing your money and your time and your future. Gosh, if that doesn't make you feel good about yourself. So one of the things was, what's that, Laura?
Nothing. I was seeing if the chapters, if in here had the titles of the chapters, but it doesn't. I just turned my book on and it started reading.
Oh, okay. Sorry.
I like to keep up with the titles because it helps me remember what we talked about, but it doesn't have it in here.
Yeah, some of the titles were funny, I thought, for each of the chapters. This one mainly focused on the tax law series of incentives for entrepreneurs and investors, and then tax planning in your wealth planning, which I thought was interesting about, especially your end game thoughts and how you should pursue things and investments. Like, usually taxes are a result of your investments, but to think of them as one of the inputs into your investments is a kind of a new concept. Good place to start.
For me, that was super eye-opening, just because like our CPA, I mean, I love her, but I think I continue to say, I think we're outgrowing her, right? Because I think, Craig and I were talking offline, and she's a government CPA is what he said, based on what the book describes her as. And we're looking for somebody more in depth with what ways we can save on taxes. And I never even thought about because we're looking at financial planning right now, right? We're interviewing new financial planners, and I've got an appointment I'm going to be setting up in August with the company that I think I like the best. But this first chapter will definitely help guide me in asking them different questions, because I do want to plan around our taxes. I mean, one thing that we started doing this year was paying our kids. I had no idea I could pay each child $13,000 tax-free. And so now, they make their money tax-free, and they have to now help pay for some of their sports and their extracurricular activities. And so we will definitely be looking at the tax laws as we do our financial planning.
That was actually one of my questions later on was, does anyone know how young of a child can be to work for you? Steve, I figured you probably know.
Well, I know in the book he talked about the 9-year-old helping out with
At least 9.
bookkeeping. So I don't know how you have to like legally like input it or whatever, but I got kids everywhere here.
I don't think there's an age restriction. What the book said is they have to be compensated at a fair rate for the job they're doing. So like Steve, if you want to use the baby in your wife's belly as soon as it's born, it would have
Right.
to be like the face of your company, right? A model. You could put it on every
There you
listing.
go.
Yep.
I like
Pay
it.
it for modeling.
You have your
muted,
dog, I'll have my baby.
You're muted, Craig. We can't hear you. You're muted. Come off mute.
Yeah, it's the mute
saying
button.
you could use the drool to lick stamps and lick envelopes.
Oh, see, very creative.
His first foray into the conversation. That's what it was.
We're not judges. Okay, so that one was kind of, the next chapter was this is one of the funny chapter names is taxes are fun, easy, and understandable. That was a really short chapter 2 to capture all of that easy, fun, and understandable, because I mean, if we all were to rate us and your fear of taxes, my fear is pretty high, and you don't want to mess that up. And you feel like IRS is, well, they talk about how the government wants to make taxes for you so that you can, save as much money as you want, but they sure have quite the team of people that want to do research on your taxes and make sure that you're doing them correctly. So I sense a little BS there. Maybe that'll come up later in the book, but one of the things that I thought was the most interesting here, and wanted to ask everyone here, was his point on investing where you vacation. And I just want to know where was everyone's first thought of where you want to go buy or invest in? Where's the location?
Cartagena,
Florida.
Colombia.
Colombia?
Mhm.
Florida. I'm staying local so I can visit often.
Right.
Uh-huh.
In perfect world, I would have got a little place in Destin, but I couldn't afford it, so we got something up in the mountains, which we can never go to because it's always booked. But whatever.
Well, that sounds like a good problem.
But I mean, and like you said, I mean, my wife and I are gonna go run away to Destin in a couple weeks, just her and I, and we're gonna go be driving by, looking some stuff, and keeping track of what we're looking at, whatever. We're turning that into a business trip, like a business planning trip, and we're gonna try and call my CPA and see like what do I need to do to write the whole damn thing off.
Well, you gotta have your LLC that you actually put your money into the LLC, have the LLC buy anything, and that's your investment LLC. So the investment LLC is taking you on, take traveling. So you put all that money in. So you're investing from your personal money into your investment company. So now that's the write-off as far as the initial seed capital, if you will. And then it all becomes write-off as far as that goes, because now you're using that business to kind of do all your traveling, all your booking, all your expenses. Everything's paid from that corporate debit card, if you will.
Then you create an accountability plan and you become bulletproof.
Cool.
Problem solved.
Yep.
So Steve, did you have a plan to do that prior to your trip?
I mean, my thing is, and I hope we get into it in this book, it just seems like everybody always says, write it off. Just write this off, write that off. But there's no like book or no whatever that says, if you do blank, 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 you can write off blank, 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 blank. I mean, there's not like a dupe. Everybody has it, as my CPA calls it, there's the gray area. There's the black, there's the white, and the gray. And how great it can get.
In the book, he did kind of define it, though. He said that you have to spend more time working than playing.
Right. I think
Now,
like if you're down there 8 hours, you have to be there 4.5 hours working.
Correct. Right. I'm not sure how you measure that. Like, I'm sure it's just on the honor system. A question I'm going to be asking my CPA, though, is according to my CPA, like we write off every meal we go out to eat because we either say the word law or the word real estate, right? And so we write off a lot of what we do because, you know, one Thursday night a month may be financial planning, right? And that includes the business planning and that kind of stuff. And I would say we do talk business. Probably 80% of our conversation is business, just because our business is parallel.
Right.
But our CPA actually just takes only 50% of our food bill, and so she only allows us to claim
That's a
50%.
rule.
That's the
That's
law.
the IRC rule. You can only claim 50% of the total amount, because basically the IRS says essentially, we know half of this isn't really valid anyway, so we're just going to deny half of it.
Okay.
That's
Got
odd,
it.
because I mean, that's not the, you know, what I interpreted in the book was that's actually, you know, maybe for normal write-offs and stuff like that. But if you're running it through an investment company, if you will, or a separate company, and it is now a true business expense, because it's not like, yeah, you got to eat, but okay, well, no, I need to, you know, the impression that I got was that you can circumvent those standard, well, you can only take 50% of travel because you're going on. No, this has nothing to do with a personal vacation. This is straight
Oh, that's
100%.
just for meals. That's just for meals. That has
Okay.
nothing to do with anything else. That is only for meals.
Yeah, gotcha. Well, yeah, I don't know. I was on the opposite impression from that little blurb that he was talking about, that it's 100% write-offable without qualification, but I don't know.
No. So Craig, again, it's just for meals. So your meals, you can't do the whole thing. Now you can reimburse yourself for travel meals. That's different.
Okay.
So it's really how you look about it. That's why you create an accountability plan, because essentially you create an accountability plan for the whole year that determines how you do all of that stuff. Therefore, if someone comes back, you don't even have to really go back and say, oh, well, we did it this way. It's like, well, we follow our accountability plan. It doesn't matter.
Gotcha.
Wow. Good to have experts on the call.
There you go.
Craig, you didn't say, where would be your vacation destination?
Well, since Laura took Florida already, I guess I would throw, well, I don't know. I like Costa Rica. If I want to put something out there, that beyond that, I would say maybe like something out in Utah area, like Salt Lake City in the mountains, Jackson Hole, Wyoming. That sounds really like a nice place to visit. I'm getting faces. Mountain homes, ski resorts.
Oh,
Yeah. So I mean, that's obviously the warm place. Costa Rica is a warm place, but as far as for snow skiing and snowboarding and all that stuff, I'd probably do something on the west coast. And I mean, I think Jackson Hole is just a phenomenal place for that.
That's exciting. Well, worth going to visit to see if there's any potential.
Fair enough. Yes, and then we'll have our plane for our other write-off, because you got to get there and travel.
It's good. That's good. I like that. Good goals. Okay, so then that brings us to chapter 3, which was the 2 most important rules. And I love these. It's your money, not the government's. That's kind of new concept. You know, we're all used to we get paid second, it seems like, whenever you look at your checks. And then tax law written to reduce your taxes. Both of those brought aha moments to me. Did either of these surprise anyone, or did you guys have any?
I like the idea of, you know, it's our money. You know, we pay the government, you know, off of that to fund all the programs, whatever, but it's not like, because there's a lot of people who say, you know, they get like, why are you writing off all your taxes? You know, it's like, why, you know, why? That's the government's money. You're stealing from what? It's like, that's our money. You know what I mean? And if we can legally do it to where, you know, the reason we have all the write-offs is so that we're funding, you know, like businesses, and we're helping out, you know, small businesses in the area and whatever. And, you know, and we are incentivized for that through that. And I like that approach of, no, this is our money that we pay in taxes to the government. It's not the government's money that we're begging for back. I like that he made that kind of whatever.
known right up front. And like he was in a conference or something, and one of the people said, well, why are you stealing from the government?
Right.
And I think that's a common
Right.
mindset.
The government's stealing from us.
It kind of flipped the script on me in regards to a lot of times, I don't know, I think Laura and I talk about sometimes, stereotypes, where do stereotypes come from and are they true or not, right? If they weren't true to some extent, they wouldn't become a stereotype, right? And one of the biggest phrases that I've ever heard in my course, my entire life, right? Death and taxes, right? The only thing that you have to deal with. But he's really almost flipping the entire script on that, where taxes are not are not as certain as death. Death is definitely certain, but taxes are no. If you follow the tax code, you actually don't have to pay taxes, or you pay a lot less. So, just kind of changing that whole mentality that death and taxes are not, death is the only thing that's constant. Taxes are not constant, and they're not supposed to be that way, according to what the gentleman in the book is talking about, which I thought was a really nice philosophy of changing the way you think about taxes. It's not something that you're supposed to pay. It's supposed to, they're methods of increasing wealth. And so it's really an entirely different way to think about taxes in general. Now, again, I'm gonna have to pull a little bit of oops, I screwed up too as well. With Laura and I did not get all the way through chapter 6, so I'm getting close to the point where I'm going to be listening more to what everybody else is saying about the next chapter or two, because I think I got through chapter up to 5, so I apologize. But some of that early stuff was very interesting and really changing we're setting the stage of forget how you used to think about taxes, because that's not what taxes are supposed to be. And I thought that was a nice setup for, kind of backing up a little bit on Natalie from what we're talking about, to really changing how you totally think about it. And, clothes only matters and horseshoes and hand grenades, and death and taxes. Well, I guess death matters. And I guess as long as you're close enough with horseshoes and hand grenades, you can still win, but I won't change that one.
I like it.
Yeah. For me, it was very similar. So, you hear all the time, tax laws are written for the rich. For 43 years, I thought tax laws were written for the rich. Tax laws are actually written for the government so that they can drive businesses and things to the items that the government puts value in. And so for me, it was also kind of a flip of the script and a different way of looking at things, because now I realize that tax laws are written and the objective is actually not to have you pay taxes. The objective is actually to get more and more people to do the things that the government thinks needs to be done. Like, I'm super interested to learn about the different tax breaks and tax laws for people that provide housing. I mean, I have a house and I have no idea if that rental house is taking the appropriate depreciation every year, or if that rental house is taking, is filed on my taxes correctly. Motherfucker, I want it filed correctly, because I don't want to be paying those taxes. I do want that depreciation. And when he kind of breaks down, I think it was chapter 5, where he breaks down the $10,000 investment or the house, and you go through and the house ends up netting you like $13,000 for the year, but the investment ends up netting you $7,000 once you've paid all the taxes. It was like, oh, like I had no idea tax laws were written for the government. It's still a way of control, right? The government's still controlling our actions, whether it's through what we're paying in taxes or through what we're doing to alleviate the taxes. They're still in control, unfortunately, of your money. But I legitimately, for 43 years, thought tax laws were written for the rich, and they're not.
Yep.
At all.
If anything, it's written for the entrepreneurs and investors.
Mm-hmm.
And
expanding on both those comments, it's you hear about part of the reason that in my past life, if you will, prior to this book or starting the book, is you always get upset about taxes because the government spends them inappropriately. But it's almost like, well, stop paying me the money for me to spend it inappropriately and spend it the way I want you to spend it in the first place, right? So hey, instead of giving me the money to stir the economy, go invest in real estate and go hire some people to manage your real estate, right? Spur the economy, and then if you do that, we're going to give you all these. You don't have to pay taxes because you're doing what we want you to do for yourself, right? It's very interesting as far as the social policies that these tax strategies are much better, in my opinion, than let's take money and reallocate towards this, or take money to reallocate towards this, or just, so how about I just take my money, I spend it, and I don't pay taxes because I'm spending it the way for the society, right? And I'm creating jobs, I'm doing all this stuff, so I don't need the government to do it for me. I'll do it myself and not pay taxes.
So when I was in school at Georgia State and they were kind of teaching tax, it was really interesting because the way they taught it, they actually taught you that a lot of the tax laws are written because the government doesn't provide certain things. So, like, for instance, the government doesn't provide housing. They provide a lot of subsidies for housing, but they do that through the tax law. And then they, like, the same thing for energy. They don't actually do anything energy related, but they provide a lot of subsidies for it. And so when you kind of think of it that way, I've always kind of thought of it that way. And it's like, it's like, okay, well, I didn't realize, like, I guess, like, how, like, people don't always understand that. Like, a lot of people, he talks about in this book, it's like, oh, my accountant handles that, and I'm like, well, but do you know about this, and this? And it's like the stuff that I talk about with my friends and my accountant, my clients. But also what I thought was interesting, so when he was talking about the Internal Revenue Code, so he was talking about the actual tax laws. He was saying, 95 or 99% of it really is written to help you understand how to pay less taxes. It was really funny because as he was saying that, I was like, yo, I'd never put it that way. Like, I because there's a section that talks about income, and then there's a section that talks about excess type taxes. And as long as you're not selling alcohol, selling like weed, or selling like basically the illegal stuff, like for the majority of it, it's really about how to pay less in taxes. And so it's like, it's a very small position. Like the excise tax is just Title 26. That's it. And you never see it again. I was like, I never put it together that way. I thought that was interesting.
Yeah, no, that's true. And then that's what he said. Chapter 4 was put money back in your pocket now. And one of the things was reduce taxes now, make everything you do decrease your taxes, and then change expenses from personal to business taxes. And I think that's where he mentioned the Costco example about buying gas at Costco, because he doesn't do it there because they don't accept his credit card or his business card. And so he goes down the street, and the return he gets because he did that with his business card versus the 10% savings he would have got with Costco outweighed it. And it's like, wow, that's thinking step by step of your life.
What's being very purposeful, and I think that goes back to other books that we've read, right? Have a plan, right?
Mhm.
To David's point, have that plan, understand what you're going to do for the year, and then you know exactly where to get gas from and where to buy whatever it is you're buying and what credit card to use. And I think if you're purposeful and you have a plan, which is why having a CPA and a tax advisor who understands all of this is so important, because you don't know what you don't know. Like, I would have had no idea that Costco wouldn't take my business card. I didn't know they didn't take that.
Well,
Or
maybe you
Sam.
get the American Express. I bet if you have a Visa, it would take it.
The one cool thing that they said, and I don't know what chapter it was in, is one of the first 6, but they talked about how like we don't have to know the code. And that's the cool thing, that it's like we just need to know like the themes or the ideas. That's why we have a CPA. That's why we hire somebody that knows that stuff. Now, I don't need to know that stuff. I just need to know the concepts, work with them to kind of be sure we know them. But that, because that was my worry, was that we're gonna have to like really take advantage of taxes. We're like, crap, I gotta crack into the code, and
You gotta learn it.
I don't have time for that crap. Motherfucker.
Yeah, I mean, that was an interesting, I guess along the same lines as I did not hear the gas card issue. I guess, that was one of the things that I missed, but I did hear the one in regards to evaluating investments, which, definitely something that's always on my brain. And I talk about it within my business practice as well as on the personal side of everything. But taking into account the tax implications of the investment, you're always talking about, rate of return and, is this a good deal or not deal? What's the profit margin, et cetera, et cetera. but that's all like pre-tax conversations, right? And then when he kind of ran down with, obviously most people that other than me, to some extent, are definitely in the real estate profession here. But it was very much a promotion of, oh yeah, don't discount real estate. You actually make more money because of the tax code on the back end. You get so much more stuff. So it's not just getting a 7% return or a 10% return. As a straight investment, you're getting so much more from other benefits that you're able to do on the back end that you don't get with other investments. So, just that whole philosophy of don't look at things in a, with blinders on, but you got to look at the totality of what's going on and what is the implication pre, post, and and subsequent. Another really interesting analysis of evaluating a business opportunity that I've never heard anybody talk about that on the back end. And I've talked about lots of business opportunities. A lot of PPMs come across my desk, and I'm doing a lot of stuff, and we're talking about returns and stuff like that. But it's never talking about a lot of times as far as the investment opportunity, the tax benefits of that type of opportunity, subject to more your traditional stuff like a 1031 exchange or something along that. That's obviously clearly tax related, but or anyway, it was really interesting start of a conversation.
Yeah, it's a change of your thought process.
Mm-hmm.
So this book actually ties back well with where he kind of talks about like the different how to read a financial statement and how to like analyze one. So I'm glad that he brings this point up, because looking at something after tax is a big difference than before tax, because after tax you can match the cash. Before tax, it starts to get weird, because as an accountant, when I go to read a financial statement, generally the KPI that people are looking for is earnings before interest and taxes, or earnings before interest, taxes, depreciation, and amortization, which is EBIT.
EBITDA.
Yeah, and so it's like, I was always confused, like, why do you guys even care about this number? It's like, how much are you paying on taxes for that? Because then that's what you got to turn around, and when you call a dividend, you got to pay folks.
Mm-hmm.
Well, that's money coming out of operations. So I was just always confused, like when people would look at, analyze an investment, they would look at the like the numbers, but they would never go to the tax. And so I just always sat on the side end for so long. Like I just don't get it. I don't get it. But like talking through that, that's like, I feel like that's huge. And I feel like a lot of people don't fully like understand that.
Mm-hmm.
I don't think my CPA understands that.
Well, something they also pointed out, and I think I may be skipping ahead. I think it was chapter 5. Like, we do a lot of tax planning by deferring taxes. And he was saying in the book that that's what a lot of CPAs do, as opposed to knowing what to do with the money now. And if instead of deferring the taxes, you avoided the taxes by having an investment or having a company or having some other place for that money to go, or an expense for it to be spent on today, that it actually, the long-term benefit is actually better for you, because instead of deferring those taxes and sticking that money someplace you're going to pay taxes on them later, stick them in real estate where they're making money and helping minimize it. So that was super like eye-opening for me. I was like, oh, womp, womp, womp.
So you can actually see that on financial statements as well. That's something that's very interesting, and companies do it. It's called a deferred tax asset and a deferred tax liability. The larger their asset is, the more they're deferring their tax liabilities. And they call it an asset because essentially it, by the time you do all the calculations, it converts to cash. And then the same thing for the liability. If they're, sometimes you'll see they'll start to kind of take taxes immediately, and then it'll kind of build up a liability, but then a lot of the times it'll revert backwards. So, but you can see it on the financial statement.
Yeah, that's intriguing. So I got 2 more for you. One of the things was, I wanted to ask everyone, does anyone know anything that's not a tax write-off? I know of one, but
I'll go last.
Interesting. So I did look it up. I was previously a member of a country club, and your membership at the country club is not a tax write-off. Now, your food that you buy for people or pay for someone's golf while you make a business deal, those things could be, but your actual dues are not. So it's not a good investment.
They're not a write-off.
But
Even if the business joins it as a,
I don't know. I looked at it more as a
Personal?
soul, but
I
now
don't
there's
know,
other
member of
things.
the country
Oh,
club by any means, but I don't know. Not that I ever, it's not on my bucket list either, but you never know.
but like if you got season tickets at a game, or that, those are tax write-off as entertainment.
Yeah, that's actually something we talked about doing last year, was splitting box seats at the Alpharetta Amphitheater with a couple other companies, and then, you know, having the tickets to use throughout the year and being able to give them to clients and that kind of stuff. Because if you get box seats, a lot of times you get, you know, the box has multiple seats. So if
Mhm.
Craig and I and the other people we were talking to, but yeah.
So as much as it pains me to say this, but I would talk with your tax professional before writing off entertainment in recent years.
Good to know.
Is there something in entertainment that you know of, David, that's not a tax write-off?
That they removed a few things that were considered write-offs, and entertainment I remember being one of them. It used to be meals and entertainment, but then they got rid of entertainment.
Interesting. Okay, well then the last thing I had for everyone was, you know, we're only 6 chapters in to this book. We got quite a ways to go, but kind of your thought process on a scale of 1 to 5, like how well do you feel you're personally or professionally, your business is doing on being a tax-free wealth person or company? Did you say 5?
I laughed at myself because I'm like, it's probably just like a 1 if you're only a 1 out of 100. You know, I think David, I mean, you and I have been talking. I know I've definitely talked to you, Laura, about it. And I'm trying to grow my practice in a way that is going to add this piece as a substantial estate planning and life planning as far as for tax mitigation and tax deferred strategies, utilizing, you know, common law trusts and some foundation stuff and business trusts to try and kind of do all that. So I am in the process of getting there, but I'm at a 0 or a 1 right now, other than the fact that I just charge everything and hopefully my accountant writes off as much as possible.
Yep.
So that's my current tax planning. Just charge everything on the business and let the chips see, and let, you know, let God sort them out, I guess, right? Kill them all, let God sort them out. Pay it all and let the accountant sort it out.
I'm at a 3, but I don't do mine on my own anymore.
I'd say like I'm a 1 or a 2, but I think I'm probably of the same boat that Craig's in. Let's just charge it all. Here's my shit. You tell me what's gold. What we can do.
And Laura?
Yeah, I'm right there with my husband. I am definitely, we are at a 1, and it's, I don't think we're at a 1 though because we haven't tried. I think we're at a 1 because we haven't hired the right people. And we unfortunately, you know, we hired a financial advisor who introduced us to our CPA. And our financial advisor, you know, he wants to see all our money in stocks, which is not where our money is, right? We move a lot of our money over towards real estate and other things and whatever. And so I think we're a small fish in his big pond. And I think he likes the CPA that he introduced us to because she's safe, right? She doesn't take a lot of risks. She doesn't, you know, if you get audited after she's done your taxes, odds are you're not going to owe anything because you've probably paid too much based on where you are as an entrepreneur anyway. But I think Matt likes that because her suggestion is to defer taxes, which if I'm deferring taxes, that means I'm putting more money in our owner K or in our Roth IRA or I guess the Roth IRA is not deferred taxes, that's after taxes, but we're putting in those accounts that helps Matt grow his business. And so, you know, I would say we're at a 1, but again, not from lack of trying, but more lack of education and lack of having the right people in place. So
Mhm.
hopefully Craig figures out this whole tax thing and our new financial advisors figure out their end and we make it all work.
So, you know, and along that same lines, and I think, you know, my negative on our service providers, and I know it's not part of it, though I did overhear some of Laura's prior readings, I guess with Richard, the rich dad, poor guy, and like the quadrants that he talks about, right? So for me and Laura, and I think everybody on this call is more on the B&I categories, right? Business and investors, right? That's kind of what everybody on this call is. Now, the problem is our service providers are not in the B&I. Our service providers are on the W-2s, right? So you got a W-2, you're straightforward, okay, 401, IRA, and that's it, right? That's kind of what you do for investments. For tax returns, you got a W-2, you put your W-2 on your thing and you're done. So our accountant is a worker bee accountant, and our financial advisor is a worker bee advisor. We need advisors that are in the B&I space, not in the worker bee space. So that's kind of where we've and now this is all stuff that we're learning, at least I'm learning. You guys maybe are definitely ahead of the game on me on this one, but I think that's kind of where I think our service providers are failing, is they're not servicing our quadrant. They're servicing the other quadrant that I don't want to be in.
Awesome. All right, guys. Well, I think we're about to drop, but
We have about 40 seconds. So what chapters next week, my friend?
7 through something. I'll let you know.
Okay, perfect. Just text us.
Fair enough.
Sounds
Just go
good. Well,
listen.
before we cut off, peace.
Deuce.